Welcome to Commercial Real Estate Now in partnership with CBRE Debt and Structured Finance and my co host, Farhan Kabani. Farhan, welcome to the show. Great to see you today.
Hey, Carly, great to see you too.
We are so excited to kick off this monthly partnership where we cover all things finance related. And I could not be more pleased to have you as our co host moving forward. Before we jump into what is some really fascinating content today, we've got a lot of material. Why don't you take a moment and just give us a quick background on yourself and your team?
Thanks, Carly. I lead a debt and structured finance team that focuses on commercial middle market transactions, serving a wide range of private to institutional clients. I've spent almost 20 years in the space, closed over 5,000 transactions with nearly 7 billion in funded capital.
Great breadth of knowledge. I know we've done some transactions together and your team is top notch. So happy to have you as a partner in this endeavor. Let's jump into today's topic, which we have a lot of ways we could start here, but we would be remiss to not start with the political election, which just happened last week. Tell us what impacts near term you are expecting on the finance market from the political election.
Sure. Well, overall, there's been general optimism as it relates to the outcome of the election, which can be seen in equities for that matter. But the overall expectation is that there will be less stringent regulatory controls over banking and the financial services sector. This could free up capital for banks and non-bank lenders, for that matter, increase M&A activity and domestic investment. So overall, it's all good news for at least for our industry.
We all love the sound of liquidity flowing back into the market, and that's very welcome news. But on the other side of the coin, we noticed that the 10-year has spiked significantly, and I believe that is directly tied to our lending rates. So how do we interpret that, and do you expect that to come in?
Well, it is all relative. We've seen 10-year, move upwards slightly. I know we consider it looks significant in the near term, but overall it's relatively modest. However, the forward yield curve seems to suggest that rates are inbound, that we're not going to see a dramatic shift in either direction. So over the next 12 months, it's likely that we stay, within this low 4, upper 3 range.
Wow. So talk to me for a minute then about the relationship between the federal funds rate and the 10-year treasury.
Well, Fed funds is determined by the FOMC or the Federal Reserve, and there are more controls over the short-term interest rates in that regard, as well as monetary policy. So when Fed funds changes, prime changes, and you'll see an immediate impact to consumer debt, or some impact to consumer debt as it relates to floating rate products that are based off prime. Inversely, the Fed does not have as much control over the U.S. Treasury yields, at least at the long end of the curve. And most of our interest rates are determined on that between that 5 and 10-year fixed range, which is based off of 5 to 10-year U.S. Treasury yields. That is with a spread over 5 to 10-year treasuries. So there's not an immediate impact necessarily to the long end of the curve. I think the longer term direction of the Fed, as well as monetary policy related items, will have an impact on U.S. Treasury yields. But the broader market also really determines that pricing. And as it relates to all-in rates, we could see improvement in terms of easing, but there's not an immediate impact from a Fed funds adjustment to the 10-year UST yield.
And I think that's pretty widely misunderstood. Maybe not in our direct industry, but with a lot of investors, we'll get calls saying, "Okay, well, Powell lowered rates another 25 basis points, so that means my property is more valuable today because cap rates came down, exactly in tandem, and everyone can borrow cheaper," which, as we have seen in the last 6 months, is not really the case. So the relationship that you just explained to us between the federal funds rate and the 10-year treasury almost sounds like it's obviously they're correlated, but there are many other factors at play. Give me an idea of what might drive the 10-year Treasury to move in the opposite direction of the federal funds rate. What are some of those factors?
If there's long-term inflation concerns and long-term inflationary concerns, that would impact the long end of the yield curve, or the 10-year Treasury. If there are concerns, recessionary concerns, that could impact the long end of the curve. Higher borrowing as it relates to the federal government and trade, that could also impact the long end of the yield curve. So there's risk and duration that all come into play there when seeing the 10-year move in one direction or the other.
Very interesting. So it sounds like the cuts that the Federal Reserve is doing are certainly welcome, but it's not an immediate translation to borrowing rates, correct?
Correct.
You can say no.
For
Okay,
at least for
I'm okay
fixed term
being wrong.
products. No. If for fixed term product, for longer term fixed term product, correct. For floating rate products, for consumer products, for construction loans, for that matter, there's immediate easing. There's been some immediate impacts there with adjustments to Fed funds. So I don't want to categorize necessarily the same way, or put everything in one bucket. I will say those again. There's improvement to floating rate products. There's improvement to the short end of the yield curve, or at least shorter term duration deal loans, whether that's including consumer loans, as even commercial real estate for that matter, but primarily those that have shorter durations. The long end of the curve, or at the longer end, long-term fixed products, those have not seen an immediate impact.
So we're in November. We've got one more Fed meeting next month, and then we kick off 2025. What are you expecting at the next meeting, and how do you think we're going to end the year? And I think this goes without saying that all of this is prediction just based on our market knowledge. So I'm not holding you to this exactly, but what's your sense of how the year will end up?
Well, if there's a correlation to the forward yield curve, the assumption is, as far as interest rates are concerned, long-term interest rates are concerned, it seems to be more of the same. As it relates to further adjustments to Fed funds in the path, I think the next meeting really gives us a lot of good information as it relates to the dot plot moving forward and what to expect the number of cuts next year, whether there's a cut this year or not, or another cut this year or not. The overall expectation is that Fed funds will adjust one more time this year, moving into next, but a lot of the data is really what's is a indicator of what could occur, right? If the Fed does change course. Again, the overall expectation is still that 125 basis point reduction, but there's still employment data that remains to be considered, and that's a bit of a question mark. There's the two inflation reports, I believe, this week. GDP figures, I believe, before that meeting as well. So there's a lot of data that has will be released in advance of that next meeting, and then that meeting itself, I think, will give us a lot more insight, not just a rate adjustment, but at least that dot plot moving forward and what to expect over the next 12 to 18 months.
It would be nice to have a sense of where things were going for a change, right? The last few years have been so volatile. It'd be great if we had increased transaction velocity and some predictability for a while. So fingers crossed that we get that over the next few months.
I agree.
You mentioned all these other factors, which of course we all watch, the unemployment numbers, the inflation. Do you have a sense on how much those data points affect lenders' decision? Well, let's talk bank lenders. Well, it's because I know the categories are different. Let's talk traditional bank lenders. Are those data points maybe signs of economic weakness in some ways? Do those affect how freely they lend, or is it more an equation over their own internal borrowing rate and liquidity?
It's a great question. So as it relates to bank lenders, a lot of it has to do with, there are market risks that are taken into consideration, but I think that's on a micro level, depending upon asset class. As it relates to their capacity to lend, that's really heavily weighted by their internal borrowing costs or cost of capital. loan to deposits. That all factors into the overall capacity, and then in turn impacts credit decisions or
Got
treasury
it.
related decisions.
Yeah. Okay. Interesting.
Yep.
And then let's move on to spreads. Do you think the borrowing rates over the lending rate are widening? Are they tightening? What's your prediction on which way spreads are going to go?
So I think spreads are in a competitive competitive range right now. That said, there may be some room for tightening. Nothing dramatic, but if you track corporate bond yields, and we've seen how investment grade corporate bond yields have seen the tightest spreads we've seen in a very long time, or at least the tightest all-in rates, which are impacted by those spreads. That could suggest that in certain lending categories we'll see further tightening. That said, for the end of the year, there's not a ton of room for the rest of the year anyway. It's not like you could app a deal today and close by the end of the year. So a lot of that's really an indicator for the first quarter. So if you're, say the life insurance companies, we should see slight tightening based on where corporate bond yields are at. We should expect it. Maybe even in CMBS space, we might see further tightening, and that could lead to better all-in rates at the start of next year, assuming no major change to U.S. Treasury yields.
So we've got lots of factors at play, but two things to the positive: hopefully lower federal funds rate, and then maybe tighter spreads should work in together, right, to bring the borrowing rate down. Am I too wishful there, or is that a potential?
It's kind of one or the other or both, right? You want
Okay.
Treasury yields to come in a little bit, and hopefully that we'll see a slight adjustment there. Even if a couple months ago when we were sub 4%, and on the all-in on the 10-year, and similarly, if we can get a little bit of tightening in spreads or credit spreads, I think the overall marketplace should applaud and expect activity to increase. Wishful thinking, possibly, but
Yeah, exactly.
I'm up for optimism.
And that kind of brings me to my next question: is how is this monetary policy, in your opinion, affecting investor sentiment? Have you seen loan applications tick up since the Fed began cutting rates, even though actual borrowing rates haven't shifted that much? Or have you seen activity be pretty consistent throughout the year?
I would say refinance activity picked up following the previous Fed cut. Acquisition activity generally ticks up at the end of the year anyway, so we saw a fair share of applications for new acquisitions. But overall investor sentiment, I want to say at least there's, in some capacities, they're able to start benchmarking rates and valuations, so that could improve acquisition activity outside of just the year-end push, or call it pent-up demand for that matter, and that could also flow into the following year. I still expect refinance business to maintain at a higher level, just given the amount of loan maturities coming due, even following extensions given possibly this year into next year. So there's a pretty big glut of maturities coming due. So that should still continue to lead to refinance business, which again has picked up in the last quarter, and that's more of a market requirement, or call it investor requirement. Investors have to take action, not so much that they're have a desire to take action.
Right.
It's required.
Not opportunistic, right?
Exactly.
They don't have any other choice but to
Yep.
refi. Are you seeing the blend and extend, pretend and extend? There's lots of nicknames for it, but the loan extensions in the basic form continuing the way they have been the last few years? Or are you seeing lenders coming up against maturities be a little more hard-lined that it was time to refi or pay off the loan? Has that changed?
I feel there was an inflection point in the third quarter where lenders were, basically giving landlords or borrowers the hard pressed, hey, you got to get this loan off our books. And that's after a variety of extensions. I feel a lot of that was also related to the potential decreases to Fed funds and ultimately all-in interest rates. So banks felt that there was more opportunity for investors to refinance, and they weren't constrained in terms of the number of lenders or the availability of capital in the marketplace. We've seen that rates have stayed relatively in line to where they were, say, earlier this year, call it 6 months ago. So now towards the end of this year, leading into the end of the year, more and more lenders seem to be reasonable and willing to kick the can down a little bit. I do think it's split, 50-50. It's hard to tell you how many lenders are really willing to extend, but just in general conversation at a micro level, we'll have one set of borrowers that said, hey, we got an extension for 90 days, primarily in certain asset classes like office, right? Those that are harder to refinance.
Right.
And other borrowers that are saying, no, our lender said we need to refi. They're not going to provide any further extensions. And usually that's also related to the underlying asset class, the lender knowing that there's a high probability that the investor can find a replacement loan.
Right, exactly. So they're pushing a little harder on loans that they think could be performing long term, and
Sure.
maybe extending on loans that they're like, this is tricky. We don't want to take a loss on this.
Yeah.
Yeah, that makes sense. Have you seen a lot of stress in your lending relationships? I know there's been, obviously my team doesn't do office specifically. I know cover all asset types. Have you seen a lot of stress with the lenders that have heavy allocations to office still, or those kind of working through and they're back lending across the board? Because I heard that was constraining lending overall. Is that still the case?
So you bring up an interesting point. There is a segment of the market that had pressed pause in certain asset categories well in advance of the overall market stress and heavy regional banks taking on considerable or call it inappropriate levels of debt to deposits, loan to deposits. So that segment of the marketplace seems to have rebounded and come back to lend further, or at least consider certain call it problematic asset classes, or at least come back stronger in terms of lending, i.e. like money center banks, larger money center banks. I'm not saying money center banks are necessarily coming out and lending on office product, but you've seen a larger outlay of loans from money center banks than you did earlier in the year. I think I answered your question there. I'm not sure if I did. I tried.
Yeah, I think so. The money center banks, you left me a little bit on the end, but I think we've got the gist that everybody's working through their office allocations and finding ways to still lend on things that they feel are not too risky. Mm-hmm. That's what I'm going with on that.
Fair. I'll take that.
I want to go through all the different lender types and talk about where they're really shining and who's most active, but we're going to save that for next month. So for everyone listening, know you can tune in next month and we're going to take a deep dive on who's lending on what and who's most aggressive and what these different lender profiles look like. But for today, is there one group, life companies, banks, whatever it is, CMBS, that reacted most favorably to the political decision that was just made to the presidency? Or you could take that another way. Is there one group of lenders that is responding most strongly to federal monetary policy easing?
I would say a group of lenders that's looking favorably upon federal to adjustments to Fed funds or monetary policy. I would say banks, right? That you'll see an immediate impact to banks. So they're looking at it very favorably. In terms of the most active lenders, at least likely in the first quarter, would be life insurance companies, but I think it's unrelated to the election, or necessarily just primarily monetary policy. The life insurance companies have been aggressive throughout the year, but they have fresh allocations for the first and second quarter, and so they will probably be the most competitive in all-in rates.
Interesting. I like it. All right. That was a good tease for our next episode. Anything you'd like to conclude with relating to the election, relating to monetary policy, just where we are at this point in the year? Any parting thoughts?
Parting thoughts is I'll shy away from politics because we already talked too many politics on the show. But I think there is still growing optimism and growing optimism in the overall marketplace now that there are some clients have the ability to benchmark rates and valuations, and even lenders are in some capacity able to start benchmarking valuations, and that should improve the overall landscape for the upcoming year. And I really do think there's pent up demand for activity. People get bored; they want to take action, and I feel like that's we're starting to see rumblings of that as well. So hopefully we'll have a great 2025.
Very positive. I appreciate it. I think we are all looking forward to a lot more activity in 2025, more opportunities, more deals that pencil and can be financed. So if we could make that happen, that would be great. I know you're doing your part, but we're all looking forward to some stability and increased activity. So
before we part, could I ask you the same question? What is your expectation for 2025?
I'm hopeful that it's the same. We still have a bid-ask spread dilemma. Sellers are reticent to accept a shift in valuations that's occurred over the last 3 years. So we're working through that. Buyers are looking for deals with positive leverage in most cases. So, there needs to be that spread over interest rates. So it's still inventory working through the market, but we're getting closer. We've certainly seen deal activity pick up, especially in 1031 exchanges this last quarter of 2024, which has been great news for our team. Most of those have been cash transactions, though. I will tell you that is still the most active part of the market for us, or the smaller deals, all cash 1031 buyers. So hopefully that continues as other asset classes pick up in velocity as well. And then we'd like to layer on, of course, some of the mid to larger size deals that require financing and get some of those moved as well. So we're optimistic, but I don't think it's as clear cut in terms of pricing as we'd hope yet. Still work to be done.
Understood. There's still underlying optimism in your commentary. That's important.
Yes. Well, I think you cannot be a broker in commercial real estate if you are not at a baseline optimistic. That goes for developers too. I think most people in our industry, right? We are born and bred to be optimistic and to frankly just find a path forward. And it may not be clear at that moment, but there's always a path, and that's our job. So, yes, absolutely. I am bullish on 25. I think it's going to be much stronger than 24. And we're certainly happy to have some of these pieces in line that we talked about already today moving in our favor. So
wonderful.
Good news. Good news.
Well, thank you again for the time and the opportunity.
Yes. And to everyone listening, that was Commercial Real Estate Now with Farhan Kabani and our CBRE Debt and Structured Finance Group. We are so happy you tuned in, and look for more debt and financial commentary next month. Thanks for tuning in. We'll see everyone soon. Take care.